The topics and opinions expressed on the following show are solely those of the hosts and their guests and not those of W4WN Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4WN Radio, its employees, or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4WN Radio.
This is Beyond Confidence with your host, Divya Parekh. Do you want to live a more fulfilling life? Do you want to live your legacy and achieve your personal, professional, and financial goals? Well, coming up on Divya Parekh's Beyond Confidence, you will hear real stories of leaders, entrepreneurs, and achievers who have stepped into discomfort, shattered their status quo, and are living the life they want. You will learn how relationships are the key to achieving your aspirations and financial goals. Moving your career or business forward does not have to happen at the expense of your personal or family life, or vice versa. Learn more at www.divyaparekh.com, and you can connect with Divya at contact@divyaparekh.com. This is Beyond Confidence, and now here's your host, Divya Parekh.
Good morning, listeners. So I'm calling from New York, and I gotta share with you. I'm at the ocean, and ocean gives you such beautiful vibes. And it just brings you so much joy and that calm and connects you with the nature. So it's important to take the time out of your life and connect. So let's bring in our guest today. Our guest is Andrew. Welcome, Andrew.
Thank you.
So Andrew, share with us a moment or a time where probably, sometime in your early youth, when you remember what's going on. And was there some person or a moment that left a mark on you?
That's a really good question. I don't know if there's a person. Trying to think of that one. That's a good question. But yeah, actually, I had it just so happens that I had a mentor when I was first getting into a bank training program who wanted me to be in the investment department. And he was a very experienced, very well-respected person in that organization, very senior person. And he kind of, he supported my efforts in the investment function at that trust department of bank. So I was very fortunate to have that support. And it opened my eyes to an opportunity that I pursued for the rest of my adult life. Okay. Are we on? Can you hear me? I don't. Did you hear my response? Divya? Okay. Can you hear me now?
Yes.
Good. Did you hear my response to your question?
Yes, I heard your response that a mentor really helped you out.
Yeah.
So tell us, how did you get into finance?
Well, that's how I got into it, because he introduced me, and I didn't know anything about it, but it was fascinating to me and a challenge. And I was fortunate to be put into a position at a very early stage of my career that was a very important, responsible position. And I just took it from there. And I just did it. I don't know how to say that, but I just thought this is good. This is fun. This is helping people. I understand what's going on here, and I was helping my clients. So yeah, it was very gratifying. And I was married with I was married. I didn't have any kids at that point. I did shortly thereafter. So yeah, it looked like a good opportunity to me. So I just pursued it.
Oh, fantastic. So can you share with us, people may be starting out, people are at different periods of their life journey. How can they get into investing? What
Well,
is
okay. First thing I want to say is what my experience, and this is what I discussed in my book. And my experience is that most people that I talk to anyway are intimidated about investing. They say it's chaotic. They don't understand it. They want to leave it up to somebody else, and I understand that. And money is a very it's a very touchy subject for most people. Most people really don't want to deal with it. They don't wake up in the morning thinking about difficult decisions they want to make with their money. So what I would say is that and this is just my experience in history. But the best way to preserve the purchasing power of your money is not by putting it into a bank where you could almost be positive that the value of the purchasing power of your money will decline as inflation goes up, because the interest rate you're going to get in a bank is not enough to offset inflation and taxes. But investing in stocks will. Now, but that scares people because it's uncertain, it's deemed to be risky. And one of the things I wanted to do in my book is to help people develop a mindset to overcome the anxiety and indeed look at the opportunity to save your money and invest it, by the way, to preserve its value, as something that you should do with confidence and joy. And in fact, I wanted to name my book "Invest with Confidence and Joy," but my editors said, "No, you can't do that. You can't do that." I said, "Well, okay, but that's what I want to do, because that's the way I look at it. It truly is." And being mindful of your own anxieties is really important, and you have to try to separate that emotional reaction of being fearful of losing money to the fact that over time the stock market really has been very, very productive for people who have invested in it on the long term. And I based my book on behavioral finance and my practice on behavioral finance, and one of the things that one of the most famous behavioral finance people, who's now passed on, Daniel Kahneman, said in his book, Thinking Fast and Slow, is that people are 2.5 times more concerned about losing money than making money. And that is true, I have found. And I don't know how he exactly derived the 2.5 times more concern, but he did. And I accept that. And that's where people get hung up. They have to understand that not taking risk is a risk to your financial well-being. And the other thing they have to understand is you are your own chief financial officer. Whether you have somebody helping you or a wealth manager or a friend, you still make the decision. So you have to take charge. So just I hate to say this, take ownership, because literally it is ownership of your money. So you have to accept that responsibility and discharge it, for your benefit. And that's
So we can kind of sit here and say, right, that go take charge of that ownership. And so many times what happens is that there is that knowledge gap. People want to take it, but then there is that gap. So we are going to explore investors at different times in their lives. Let's say, we're talking about young professionals, young entrepreneurs in their 20s, and they're getting started. What are some of the things that they can keep in mind as they are working through their mindset? And how can they get started?
Well, I think the most important thing, Divya, is that people have to make a decision to save versus spend. That's the most important thing. And that's called a time preference decision. All right. So once you've decided to save, then you have to decide how are you going to invest your savings? Will you keep it in cash? Will you keep it in a bank? Will you invest it in something else? And what's happened in the last 15 or so years, 10 or 15 years in particular, is that the accessibility of prudent investment vehicles has increased a lot, and the cost of it has gone down to almost nothing. Okay. And so so what people have to start out by doing is, okay, I decided to save. How am I going to save? What can I save? And what I would suggest to people is to go to a simple interest rate calculator and calculate if you save, $100 a month and it grows at 6% a year, how much will that be worth in 20 years? And just do that calculation. It might take you a minute on the internet. And you will see that the numbers are astonishing, because compound interest is Einstein was right. It's the eighth wonder of the world. And it really is, but most people don't understand compound interest. So then take that same example of, say, 6% and move it to 7% and see what that amounts to. And 7% is a very reasonable objective for a return for most people. Of course, you'd like to make more. But just do some math and say that should be a very powerful motivator for people to stay on track with their investing. And, I think that's lesson number one. The other thing to do is for people you asked about young, people in their career, people earlier in their careers, the importance of savings is good, but the most important thing they have time. That's a very valuable resource. Time is an incredibly valuable resource. So take advantage of the time that you have to invest and do those calculations and see what it looks like in 10, 20, 30 or longer years. And you'll be pretty surprised. The other thing you have to do, and this is specifically what I talk about in my book and what I do, is people have to know how much risk they want, how much risk they have, and how much risk they need. And those are the three questions that they have to answer. And those are the questions that in my particular approach to the world, and you could see that on my website, there's a short video that explains how that works. But look at what it really means to what is risk. Well, risk is losing money. It's not making as much as you could make. And it's other things. But you have to understand what risk means to you and how you're going to address that. Because if you don't take risk, you won't make any money. And that's just the way it is.
That is definitely the case, right? If you're not going to have certain amount of risk, then your money could be sitting in the bank and not give you any passive income, as you very rightfully said, and that the value goes down as the inflation goes up. So in terms of the risks, now let's say these professionals have advanced, they're at a point in time in a good job, and now they're getting 401k. So one of the key things about 401k, because now, pensions are unheard of. Nobody talks about pensions anymore. Maybe there are pensions in some of the companies, but that is an outdated thing most of the time. So the thing is that they cannot take out the money until they're 59 and a half. And who knows, the age may go up as we are living longer. So what is the best way to decide that, yes, I've got to have that discipline and invest at least the amount of the money that my employer is giving me or the matching me for whatever I invest?
Yeah, well, that is the central question. And I think the answer to it is people should look at, again, I try to explain this in as simple terms as possible in my book, and that is to look at the history of the stock market or financial markets, but in particular the stock market. Now, the Standard & Poor's 500, which is an index of stocks, US-based company stocks, it's 500 companies. And the index of returns goes back to 1926, so almost 100 years now. And for that 99 years, that index has produced a 10% rate of return per year with income reinvested with no taxes, which is what would happen in a retirement account. You wouldn't have any taxes until you take the money out. And and that's what you should just do the calculation. But now that is not to say that the stock market is an easy place to be, because during the Great Depression, it went down 85% over 3 years and it came back. During the dot-com boom, it went down about 50% over a couple of years and it came back. And the Great Financial Crisis, the same thing, over a year and a half, 50% decline, it came back. The COVID crisis was, another big 30% decline and came back. within a month. It was down 30% in a month, or 35% in a month, and it came back. And that was only 5 years ago, and it came back. So the market has always been resilient, and the investors who have profited from being invested in the stock market are also have resilience and resolve, and understand that the market will test us. It will go down. It will make us feel very uneasy, uncomfortable, and anxious. And just understand that is going to happen. So the most important thing people do, and this is what I tell people, is to understand your tolerance for investment risk before you exceed it. Because if you say, okay, I can afford to watch this portfolio go down by X%, and I won't do anything, and I'll just stay invested, and I'll be patient. But then it goes down by X plus 10 or 20%, and you're going to say, oh no, I have to get out. Well, at that point, you've increased the risk of not achieving your long-term goal, because you will have already realized a loss. And unless you get in at a lower level, which is very difficult to do, you've lost out. So just be patient. And all I can tell people is that who am I? Nobody knows who I am, but except a few of my clients, a few people around me. But people know who Warren Buffett is. And Warren Buffett's been giving this same advice for many, many years. And he says, just put the majority of your money in the S&P 500 and be patient. And what's Warren Buffett's favorite holding period for stocks? It's forever. So you don't have to make changes. And if you have a diversified portfolio that is in companies that are sound companies, and of course, companies do fail, okay, and they'll be out of the index. But you should just do that. Now, another way to look at this is to say, okay, I've only got a few $100s to invest. Well, guess what? You could actually invest in the S&P 500 through some of the bigger firms, ETFs, exchange traded funds, for very low minimums. And what you're doing is, and I don't know if you're working for a large company or not, but if you are, think of it this way: that you are with your investment in the S&P, you are engaging the 500 of the best corporate managements in the world to manage your money. And you're doing it for almost no expense. And that's pretty cool. I think that's a great opportunity.
Absolutely. No, and you said it really well that, when you're going with the managed funds or ETFs or something like that, as you're investing. So a lot of times, people are curious if they want to do it on their own or go with a financial advisor or planner like yourself. So before they even kind of do it, how can they get educated? I know you mentioned your book and website. So what's the best way to get educated?
Well, I think that's a pretty good place to start. I don't have any. I think the other recommendation I would have for a book is Thinking Fast and Slow by Daniel Kahneman.
Andrew Parrillo. Amazing book.
That's an amazing book. And, there's incredible wisdom in that. And, when we're in the middle of a battle, it's difficult to keep your eye on, the long term. You're interested in survival for the moment. And I get that. But that's exactly what the stock market will do. The stock market will test everybody's resolve. It will give us terrifying declines, and it will give us, soaring advances. And my point is, you can't get emotionally involved in that process. You have to look at it as this is what happens. This is human behavior repeating itself, and that's what it does. And now maybe maybe after 100 years it'll stop going up at 10% a year over the long term. But there are almost no 20-year periods during which you haven't done very well in stock investing in this country. Now there are some 10-year periods where you haven't done well, okay, but ultimately it comes back and you do well. So you just have to be patient. Now, the big thing is, what is your time horizon for investing? If your horizon for investing is 5 years, I would say you probably shouldn't own too much in stocks, because stocks could go down by a lot and stay down for, a couple of years. And you may be, if you need the money, you're going to have to sell at a depressed price. So you have to have a longer horizon to be invested in stocks. One of the things that I say to people is, do you hire an advisor or do you do it on your own? Well, I advocate independent investing. And the reason I do that is because a couple of reasons. One is that management expenses are very, very costly. Now, I have on my website there's a calculator that might take somebody literally 20 seconds, 10 seconds to do. And it shows you how much, how much money you have, how much, your investment management fee is. It's usually around 1%. And how many years you're going to have it invested and what kind of rate of return might you expect. And you can put whatever numbers you want in there and it'll give you the answer. And you will be surprised at how much that 1% actually costs over time. And I could give some examples, but I would encourage people to go to use that calculator. There's no email required. No one's going to be asking you for an email. You just go in and do the calculation, and you'll get the answer. And and then because I think that should persuade somebody that if they are going to pay an advisor a fee, they have to do their diligence and make sure that advisor actually can add value after their fees. Because if the advisor is going to say, well, you look like you should have this portfolio and we'll put it in ETFs, we'll put it in index funds, which is what most advisors do actually. And then you say, okay, well, you're going to charge me a fee to do that. So how are you going to do better than the index if you're investing in index funds after your fee? And the answer is, well, I don't know. But I'm here for you. You could be, and most people feel very comfortable with advisors. And what I have gotten from people is, when they ask me, what have you been doing? I said, well, I wrote a book on investing. What's it about? It's just about efficient investing for individuals. And I have an advisor and they've made me a lot of money. I said, well, that's wonderful. Great. Now I don't ask them, compared to what, because anybody who's been in the stock market in the last 5, 10, 20 years has made a lot of money. Okay. Anybody. So, has the advisor made more for themselves or their clients? And that's the question that the investor has to pursue and to try to answer. And some advisors, now keep in mind, Standard & Poor's 500 has said in their studies that over the last 15 years, only 10% of mutual funds have outperformed their benchmarks, their index benchmarks. So you can find that 1 in 10 advisors that actually can outperform the index after their fees, mind you, after their fees, which they often don't disclose, by the way. They don't disclose those numbers after their fees. They just say, oh, yeah, we've done that. No, you have to add, what have you done after your fees for me? And, if you can find that 1 in 10, that's great. I think I'm all for it. Look, I was an investment advisor myself. I had my own firm, but if we didn't add value, we lost the client. So
yeah, absolutely.
I had endowment clients and I had family offices, and these were sophisticated, demanding clients. So they weren't, so they asked a lot of questions. So, and so one of the things I have in the book is for those people who are considering hiring an advisor, I have some questions and they're on my website and you can go look at the questions.
Can you share some of, because, we have listeners listening over here to live. They may be thinking, okay, Andrew, why don't you share some of those questions with us?
Well, those are the questions, and those, people are quite welcome to go and look at the questions. And, it's just common sense. It's the way an institution would approach investing the institution's money. Mm-hmm. And what I find is the interesting dichotomy that I'm seeing in this so-called wealth management industry, which is, by the way, it's a $260 billion a year industry, according to a recent McKinsey study. So and that's for wealth management. That's not institutional management, that's wealth management. So that's a lot of money. And are they adding that much value? I hope so, because that's a whole lot of money. And so, ask the questions, and they're just common sense questions. They're and advisors. One of them.
What are some of those questions?
The most important question to me is, how are you going to add value to my money after your fee? What is your structure?
You mean after taking the fees? So let's say somebody came to you.
What is what is your structural advantage to add value after your fee? And that is the question. And what do you mean, what's my structural advantage? No, you tell me how it is that you're going to beat the market. And if you're not going to beat the market, then what is your strategy and how will you add value to my portfolio? Well, I'll be here for you, and we're always here for you. Okay. But keep in mind, people, that you're paying that advisor every single day. It's not like a lawyer or an accountant. Okay. You know what you're going to pay a lawyer, you know what you're going to pay an accountant. But most people, and this is the reason I wrote the book, I asked a dozen friends of mine before I wrote the book. I said, "How much are you paying your advisor?" And I know they had significant accounts with wealth managers, and every one of them said, "I don't really know." And one of them actually said, "Well, I don't want to ask because that would be confrontational." I'm thinking,
That's your
confrontation?
money.
Yeah. So all I can say is that people, the industry makes it so complicated for people, and I think that it's ultimately a simple process that is made complicated. The news, if you look at the news, there's no way anybody can make sense of anything. If you look at the daily news, it's like,
Right.
the interest rates are going up. The Fed's going to do this. No, they're going down. The Fed's not. You know what? Those aren't signals. That's noise. Okay. And so
Yes.
the signal that you want to pay attention to is what is the long-term potential of my portfolio, not what is it going to do next week or next month or next year, but what's it going to do over a long period of time.
So basically what I'm hearing is you're saying that, okay, you've invested it, keep it for long term, and depending on if you're retiring, where you may have 7 figures after having compounded interest and all that, and depending on how much you have invested, 6 figures, high 6 figures, 7 figures, multiple 7 figures, we don't know. Now, as you're doing that, you talked about the advisors keeping some of the money, based on the fee, and that even that 1% can add over time. There are even ETFs, right? So there are different financial institutions like Fidelity, Vanguard. So for some, it may just be 0.35%. For some, it may be 0.5. For some, it may be 0.1. So how do you compare those ETFs, especially if you're doing the financial investing yourself?
Well, first of all, an ETF is nothing more than a portfolio of stocks, okay, that you have easy access to, that you can buy and sell during the trading day, unlike a mutual fund, which you can only get the price at the close of the next day. You'll find out what the price is. So the ETFs are very efficient. They tend to be more tax efficient if it's a taxable portfolio. But they're also efficient in that the charges, the fees that they charge are generally very low. It's a very competitive industry. So fees are important. How do you know whether, what the fee is, whether it's going to add value? Well, you can look at the report from the ETF company itself and see how has its return compared to the actual index return. That's for starters. And they track very closely. And they might be, literally they should be, the biggest ones at Vanguard and Fidelity charge 0.03% fee. So 3 basis points, so-called 0.03% is 3 basis points. And so literally the return that they should be showing is no less than 300 basis points less than the market return. And most of them are going to show pretty much the market return because they have other transactions they can do with securities lending and so forth that could be enhancing the return of that ETF. But that gets a little technical. But the bottom line is low fees matter. Okay. How do you decide on where you want to invest? Well, and that's an asset allocation question. How much should I have in stocks or bonds? And in stocks, what kind of stocks? Domestic, international, what kind of stocks? What is my risk score? And the approach that I take to that, Divya, and this gets very, I'm very self-promotional when I say this, so please forgive this, but it's the way I think is the sensible way to do it. People should understand what their risk tolerance is. And one of the things that Daniel Kahneman did is he created prospect theory, which, what I do is a questionnaire that's based on prospect theory. It's an iterative questionnaire. And it's like 5 or 6 questions that people could answer in 5 or no more than 10 minutes. And it produces a risk score. And what is that risk score? Well, the risk score is from 0 to 99, and the S&P 500 is 72, just for reference. NVIDIA would be 99, or higher risk stocks would be higher score. Lower risk, like money market funds, would be 0 or 1. And so you have to decide on what your risk is. And what I found is that in people that have done this risk assessment, it's a data-driven risk assessment. It takes almost no time to complete, and it gives you a score. So what do you do with that score? Well, in one case, there was a person who did a risk assessment and had a significant portfolio, was at retirement age 65, wanted to know what to do. And his risk score was 68. And I looked at the portfolio that he had been investing in his 401k for 15 years plus, and his risk score in the portfolio was 38. Wait a minute. You wanted 68, but you have 38? Now, maybe you don't really want a 68 risk. Okay. Maybe you want something less than that, but your actual risk has been 38. So what did that mean for him? Well, in his case, it meant that he lost $1.5 million in opportunity for earnings on his money because his risk in the portfolio was too low.
Yeah.
Okay. So now it could have been the other way around where, his risk was too high and, but the point is this is a very objective way, rather than saying to this gentleman, well, you're 65 years old, you're probably a conservative investor, right? Yeah, that sounds right. I'm conservative. Well, what does that mean? How do you translate that into an actual portfolio allocation? And the answer is, if you can get a straight answer out of an advisor, wealth manager, that's great. But you can get a straight answer out of me because I'll tell you exactly how I do it. Here is the risk of this portfolio of ETFs that you have. And here's what you want. So here's how we're going to adjust that to get to the risk score that you want. Again, keep in mind, how much risk do you want? How much risk do you have? And then how much risk do you need? And the how much risk do you need part comes in where we do some projections. And this is based upon probability. There's no other way you can do it. And what is the probability is based upon historical returns. And what does that mean? Well, that means that that's what people have done with their money. Okay. That's what people have done with their money. It's not what, I'm guessing that they'll do. That's what they've actually done. And that's how it's expressed in stock market returns, is because, that's just what the return has been. So, you've got to just be realistic and objective about how you're doing it. And what I do, unlike the industry, which is, I'm trying to disrupt a $260 billion industry that charges asset-based fees, which charge fees based on the size of the assets. And rather than setting a strategy, determining somebody's risk tolerance, constructing a portfolio that's a long-term portfolio, and then occasionally checking in, but not charging them every day, charging people one time to do a strategy session, to get coaching on investing, basically. Think of it as investing coaching. There's no obligation beyond that. There's no, and the other thing I would say to people is thinking about hiring a manager. I've written articles on it. The book is written on that. There's a calculator on but you have to understand what you're getting into, because that comfort level that people seek with a third party wealth manager, a wealth manager, I guess it's called. I call it investment management, but the industry has decided to call it wealth management because it sounds better. But just understand what you're paying and what you're getting. It's not. I'm really kind of. I won't say I'm agnostic on the question, because I do think that people have to prove that they can add value before you should. You should pay them. But if they can add value, oh, that's wonderful. You found the right person or people or firm. But don't just listen to the advertising like, well, we're fiduciaries. Well, the reality is that every registered investment advisor by law is a fiduciary. Okay, so these ads say, well, we're fiduciaries and we're different. Well, you're not different from every other registered investment advisor. And you charge fees on the same asset base. You're still charging a percentage of assets, whether that's 0.3 or 0.5 or 1.5. You're still charging a percent. You're going to make money no matter what. So don't tell us that you're only going to make money when your client makes money, because that's not true. You're going to make money whether the account goes up or down. And so that's kind of, but that's what people are being hit with all the time from the advertising in the industry. And
absolutely. No, very valuable advice here, Andrew. And I'm sure, some of our listeners might be even thinking, okay, how can I work with Andrew? Where can I find his book? So share with us that information.
Well, yeah, there's my website has a link to the book, which is on Amazon. So I would say it's probably the best $10 anybody could spend if they buy the ebook version, of it, the Kindle version. But yeah, you have to educate yourself, and then go forward with the confidence that you can do it and you are in charge, and just accept that responsibility, and don't deny it, and just face up and do the work. And if you want to work with me, I'm happy to have a complimentary consultation, but I would suggest that you do the risk assessment to see what your risk score is. And then if you want, then we could look at your portfolio. And again, no charge. I mean, just compliment. We could look at the portfolio, see what your risk score actually is, what you want, and then what you have. And then if you want to make changes, then we would talk about engaging me for a fee to get that advice. And what would that mean? That would mean getting the specific portfolio recommendations. It would also mean getting a specific written investment strategy letter and agreement. It would also mean getting a projection of future values in that portfolio within certain, probability bounds, starting with a 6-month projection of the return, and then going to as long as you want, out to retirement age 10, 20, 30, 40 plus years, and show it. And then input the things, how much you're going to save, how much you're going to need when you retire. Are you expecting any big additions to the portfolio, et cetera? So we can model those in, so all of that would be included in an engagement. And then if you want, after the initial period is over, then you want to check in, then we can say, please let me know in 6 months what's going on. So I'd send people an email and say, okay, let's check in, and here's what it is. And there's a very small fee to do that. So, and rather than charging them every day for essentially saying that they're monitoring their portfolio, but not doing anything.
Absolutely.
I'm just,
Yes.
this is the whole business of finance is this rough and tumble, world. And I say invest with joy and peace of mind, which is like the opposite of rough and tumble. But
Sure.
That's the way I look at it.
Yeah, no, thank you for sharing that. Well, thank you for joining us, Andrew. Thank you, listeners, for joining us. We love having you on the show. We appreciate you. And let us know what other stories and support we can bring you so you can live the life you deserve. And thank you, Juan, for making the show technically possible. Be well and take care until next time.
Thank you for being part of Beyond Confidence with your host, Divya Parekh. We hope you have learned more about how to start living the life you want. Each week on Beyond Confidence, you hear stories of real people who've experienced growth by overcoming their fears and building meaningful relationships. During Beyond Confidence, Divya Parekh shares what happened to her when she stepped out of her comfort zone to work directly with people across the globe. She not only coaches people how to form heart connections, but also transform relationships to mutually beneficial partnerships as they strive to live the life they want. If you are ready to live the life you want and leverage your strengths, learn more at www.divyaparekh.com. And you can connect with Divya at contact@divyaparekh.com. We look forward to you joining us next week.